The economic and social consequences of money laundering, socio-political and economic bad impacts of money laundering is huge. It is a result of any crime that generates profits for the criminals involved. It knows no boundaries, and jurisdictions where there are weak, ineffective, or inadequate anti-money laundering AML and counterterrorism financing CF legislation and regulations are most vulnerable. However, large, well-developed financial centers are also vulnerable to laundering due to the large volumes of transactions that allow the launderer to blend in and the wide range of services that enable the launderer to conduct transactions in a way that is convenient, because most launderers want to eventually use the proceeds of their crimes. Their ultimate intent is to move funds through stable financial systems. Money laundering has significant economic and social consequences, especially for developing countries and emerging markets. The easy passage of funds from one institution, or relatively facile systems that allow money to be placed without raising any questions, is fertile territory for money launderers. The upholding of legal, professional, and ethical standards is critical to the integrity of financial markets. The potential macroeconomic consequences of unchecked money laundering are as follows: increased exposure to organized crime and corruption. Successful money laundering enhances the profitable aspects of criminal activity. When a country is seen as a haven for money laundering, it will attract people who commit crime. Typically, havens for money laundering and terrorist financing have limited numbers of predicate crimes for money laundering, that is, criminal offenses that may permit a jurisdiction to bring a money laundering charge. Limited types of institutions and persons covered by money laundering laws and regulations. Little to no enforcement of the laws and weak penalties or provisions that make it difficult to confiscate or freeze assets related to money laundering. And limited regulatory capacity to effectively monitor and supervise compliance to money laundering and terrorist financing laws and regulations. If money laundering is prevalent, there is more likely to be corruption. Typically, the penetration of organized crime groups in a jurisdiction is directly linked to public and private sector corruption. Criminals may try to bribe government officials, lawyers, and employees of financial or non-financial institutions so that they can continue to run their criminal businesses. In countries with weaker laws and enforcement, it is corruption that triggers money laundering. It also leads to increases in the use of bribery in financial institutions, among lawyers and accountants, in the legislature, in enforcement agencies, with police and supervisory authorities, and even with courts and prosecutors. A comprehensive AML or CF framework, on the other hand, helps curb criminal activities, eliminates profits from such activities, and discourages criminals from operating in a country, especially where law is enforced fully and proceeds from crime are confiscated. We have a case study to better understanding of the real consequences. A U.S. National Security Council report in 2001 found that Russian organizations were taking advantage of Israel's large Russian immigrant community to illegally produce compact discs or CDs and launder the proceeds. Israel gained a reputation as being good for money laundering among Russian gangsters. Israeli police estimated that more than $4 billion of dirty money poured into Israel. Others estimated it at about $20 billion. These criminal gangs bought large parcels of land in impoverished development towns, taking over everything from local charities to the town hall, even hand-picking several candidates for local and national offices. This further entrenched the gangsters, ensuring they got the benefit of policies and protection from authorities. Undermining the legitimate private sector. One of the most serious microeconomic effects of money laundering is felt in the private sector. Money launderers are known to use front companies, businesses that appear legitimate and engage in legitimate business, but are in fact controlled by criminals who commingle the proceeds of illicit activity with legitimate funds to hide the ill-gotten gains. These front companies have a competitive advantage over legitimate firms because they have access to substantial illicit funds, allowing them to subsidize products and services sold at below market rates. This makes it difficult for legitimate businesses to compete against front companies. Clearly, the management principles of these criminal enterprises are not consistent with traditional free market principles, which results in further negative macroeconomic effects. Finally, by using front companies and other investments in legitimate companies, money laundering proceeds can be used to control whole industries or sectors of the economy of certain countries. This increases the potential for monetary and economic instability due to the misallocation of resources from artificial distortions in asset and commodity prices. It also provides a vehicle for evading taxes, thus depriving the country of revenue, weakening financial institutions. Money laundering and terrorist financing can harm the soundness of a country's financial sector. They can negatively affect the stability of individual banks or other financial institutions, such as securities firms and insurance companies. Criminal activity has been associated with a number of bank failures around the globe, including the closures of the First Internet Bank, European Union Bank, and Riggs Bank. The establishment and maintenance of an effective AML or CFT program is usually part of a financial institution as chartered to operate. Non-compliance can result not only in significant civil money penalties but also in the loss of its charter, dampening effect on foreign investments. Although developing economies cannot afford to be too selective about the sources of capital they attract, there is a dampening effect on foreign direct investment when a country's commercial and financial sectors are perceived to be compromised and subject to the influence of organized crime. To maintain a business-friendly environment, these impedances have to be weeded out. Loss of control of or mistakes in decisions regarding economic policy due to the large amounts of money involved in the money laundering process. In some emerging market countries, these illicit proceeds may dwarf government budgets. This can result in the loss of control of economic policy by governments or in policy mistakes due to measurement errors in macroeconomic statistics. Money laundering can adversely affect currencies and interest rates as launderers reinvest funds where their schemes are less likely to be detected, rather than where rates of return are higher. Volatility in exchange and interest rates due to unanticipated cross-border transfers of funds can also be seen, to the extent that money demand appears to shift from one country to another because of money laundering resulting in misleading monetary data. It will have adverse consequences for interest and exchange rate volatility. This is particularly true in economies based on the US dollar, as the tracking of monetary aggregates becomes more uncertain. Last, money laundering can increase the threat of monetary instability due to the misallocation of resources from artificial distortions in asset and commodity prices, economic distortion, and instability. Money launderers are not primarily interested in profit generation from their investments, but rather in protecting their proceeds and hiding the illegal origin of the funds. Thus, they invest their money in activities that are not necessarily economically beneficial to the country where the funds are located. Furthermore, to the extent that money laundering and financial crime redirect funds from sound investments to low-quality investments that hide their origin, economic growth can suffer. Loss of tax revenue of the underlying forms of illegal activity. Tax evasion is perhaps the one with the most obvious macroeconomic impact. Money laundering diminishes government tax revenue and therefore indirectly harms honest taxpayers. It also makes government tax collection more difficult. This loss of revenue generally means higher tax rates than would normally be the case. A government revenue deficit is at the center of economic difficulties in many countries, and correcting it is the primary focus of most economic stabilization programs. The International Monetary Fund (IMF) has been involved in efforts to improve the tax collection capabilities of its member countries. And the Organization for Economic Cooperation and Development (OECD) has been instrumental in moving many jurisdictions towards tax transparency. Risks to privatization efforts. Money laundering threatens the efforts of many states trying to introduce reforms into their economies through the privatization of state-owned properties, such as land, resources, or enterprises, sometimes linked with corruption or inside deals. A government may award a state privatization tender to a criminal organization, potentially at an economic loss to the public. Moreover, while privatization initiatives are often economically beneficial, they can also serve as a vehicle to launder funds. In the past, criminals have been able to purchase ports, resorts, casinos, and other state properties to hide their illicit proceeds and to further their criminal activities. Reputation risk for the country. A reputation as a money laundering or terrorist financing haven can harm development and economic growth in a country. It diminishes legitimate global opportunities because foreign financial institutions find the extra scrutiny involved in working with institutions in money laundering havens is too expensive. Legitimate businesses located in money laundering havens may also suffer from reduced access to markets or may have to pay more to have access, due to extra scrutiny of ownership and control systems. Once a country's financial reputation is damaged, reviving it is very difficult and requires significant resources to rectify a problem that could have been prevented with proper anti-money laundering controls. Other effects include specific countermeasures that can be taken by international organizations and other countries and reduced eligibility for governmental assistance, risk of international sanctions, in order to protect the financial system from money laundering and terrorist financing. The United States, the United Nations, the European Union, and other governing bodies may impose sanctions against foreign countries, entities, or individuals, terrorists and terrorist groups, drug traffickers, and other security threats. In the United States, the Office of Foreign Assets Control OFAC of the U.S. Department of the Treasury administers and enforces economic and trade sanctions. Countries can be subject to comprehensive or targeted sanctions. Comprehensive sanctions prohibit virtually all transactions with a specific country. Targeted sanctions prohibit transactions with specified industries, entities, or individuals listed on OFAC's specially designated nationals and blocked parties list. Failure to comply may result in criminal and civil penalties. FATF also maintains a list of jurisdictions identified as high risk and non-cooperative, whose AML or CF regimes have strategic deficiencies and are not at international standards. As a result, FATF calls on its members to implement countermeasures against the jurisdiction, such as financial institutions applying enhanced due diligence to business relationships and transactions with natural and legal persons from the identified jurisdiction in an attempt to persuade the jurisdiction to improve its AML or CF regime. Social costs. Significant social costs and risks are associated with money laundering. Money laundering is integral to maintaining the profitability of crime. It also enables drug traffickers, smugglers, and other criminals to expand their operations. This drives up the cost of government expenses and budgets due to the need for increased law enforcement and other expenditures, for example, increased healthcare costs for treating drug addicts. To combat the serious consequences that result, financial institutions that rely on the proceeds of crime face great challenges in adequately managing their assets, liabilities, and operations, as well as in attracting legitimate clients. They also risk being excluded from the international financial system. The adverse consequences of money laundering are reputational, operational, legal, and concentration risks and include loss of profitable business, liquidity problems through withdrawal of funds, termination of correspondent banking facilities, investigation costs and fines, asset seizures, loan losses, and reduced stock value of financial institutions. Reputational risk. The potential is that adverse publicity regarding an organization's business practices and associations, whether accurate or not, will cause a loss of public confidence in the integrity of the organization. As an example, reputational risk for a bank represents the potential that borrowers, depositors, and investors might stop doing business with the bank because of a money laundering scandal. The loss of high-quality borrowers reduces profitable loans and increases the risk of the overall loan portfolio. Depositors may withdraw their funds. Moreover, funds placed on deposit with a bank may not be reliable as a source of funding once depositors learn that the bank may not be stable. Depositors may be more willing to incur large penalties rather than leave their funds in a questionable bank, resulting in unanticipated withdrawals, causing potential liquidity problems. Operational risk. The potential for loss results from inadequate internal processes, personnel or systems, or from external events. Such losses can occur when institutions incur reduced or terminated interbank or correspondent banking services or an increased cost for these services. Increased borrowing or funding costs are also a component of operational risk. Legal risk. There is potential for lawsuits, adverse judgments, unenforceable contracts, fine and penalties generating losses, increased expenses for an organization, or even the closure of the organization. For instance, legitimate customers may become victims of a financial crime, lose money, and sue the financial institution for reimbursement. There may be investigations conducted by regulators and/or enforcement authorities, resulting in increased costs, as well as fines and other penalties. Also, certain contracts may be unenforceable due to fraud and they part of the criminal customer. Concentration risk. The potential for loss results from too much credit or loan exposure to one borrower or group of borrowers. Regulations usually restrict a bank's exposure to a single borrower or group of related borrowers. Lack of knowledge about a particular customer or who is behind the customer or what the customer's relationship is to other borrowers can place a bank at risk in this regard. This is particularly a concern where there are related counterparties, connected borrowers, and a common source of income or assets for repayment. Loan losses can also result, of course, from unenforceable contracts and contracts made with fictitious persons. Thus, money laundering and terrorist financing create vicious cycles of social, political, and economical and dismantle the financial system that ultimately hinder the global economy and instability. Thank you for joining me here and listening the insightful video for your day-to-day practices. Please do not forget to subscribe my channel for being the first among the listeners to reach me out. Thank you.